I mean, I think, we'll be well served if this recent low which we saw, which is 21,285, does not come into the picture anytime soon.
I think the economy is going to remain very, very strong.
Now, this time around, there was growth across key operating businesses.
75% of the business has registered mid-single-digit volume growth.
The Nifty has been, steady around the 21,700 mark, and that's where we're at this morning.
The previous bull market was driven by quality. The current one is driven by PSUs.
Our power plants were ideally designed for 23 to 30% of domestic coal only.
As far as the slippage is concerned, it isn't alarming.
But it's green signals everywhere, I guess, for the railway stocks because they're just not showing any signs of stopping whatsoever.
We've got about 1,300 stocks gaining, 850 stocks in the red.
While net NPA has declined by 3.9%.
The Bank Nifty, which is up around 390 points, and it's the mid-cap side of things which are doing really well as well.
Well, it's a quiet Saturday afternoon, and not very much is happening at all as far as the indices are concerned. It's the last hour for the week. Usually we say that on a Friday, but we're saying that on a Saturday. I'm Prashant, and closing bell with me, my colleagues Nigel and Surabhi. Guys, hi afternoon.
Hi Prashant, I just hope this doesn't become the norm, right? That Saturdays become the last hour of the week. There's something about a nice Saturday off that's not quite the same with the Monday off. But anyway, this Monday is different, so we'll take what we have.
There's just the look on Surabhi's face. Saturday afternoon, nice music, reading a book, chilling, taking it easy.
We'll get to it next week. No problem.
Covering the stock markets live on CNBC-TV18. Surabhi, kudos to you.
Oh, well.
We'll let her take it easy over the next 1 hour. Not. Anyway, let's quickly tell you what's going on, which is not very much actually. If you look at the frontline indices, just a few points here. As I said, it's a quiet day, except what's happening with PSUs. There is an absolutely wild ride which continues for the second straight session. Stocks are up to 8% to 15%, depending on what you look at. Otherwise, it's all quiet. Early morning gains, at least in frontline indices, they've all fizzled out. And, we were discussing the possibility of that this morning at 21,700. We got to 21,720, which is the day's high. But as we've not seen that level back once again, you need to close above that first. And then, of course, the second and the final retracement to the 61.8, which is 21,800, as we've been saying. Gains on the Nifty Bank, and the Nifty Bank today, at least on a day-on-day basis, is doing much better than what the Nifty is doing. But it's so weak that we've not even got to the 38% retracement. That stands at 46,530. We're at 46,130 at this point in time. So that's the picture. And of course, as I began by saying, no real problems for the public sector space, not public sector banks, but, the railway pack and capital goods and, all kinds of names there buzzing with activity, really. Nigel.
Well, indeed, but some of these cement numbers that are coming in there, they're looking quite good and quite encouraging. So JK Cement as well, that number looks better, but the street had a bit of a sense on that set of numbers. From Ultratech Cement, we didn't see any disappointment coming in there. So it appears after Ultratech Cement came out with those volume numbers, the street got a little bit skittish. But now with the recent numbers, Sri Digvijay Cement, they're talking about holding around 1,500 rupees per ton. You had Ultratech Cement, the numbers a little bit better, and now JK Cement as well. So the first three numbers that I'm looking at, they're good, Surabhi. But what are you tracking this Saturday afternoon?
Well, surprise, surprise, I am tracking banks. But just thinking about the reaction to Kotak, for instance, look at the way the stock is up right now, and we'll debate this as we go along with our guests, and we'll have Abhishek coming in as well. Kotak, even as we speak, is still maintaining that gain of around 2.5%, just a little off the highest points. But the issue is whether we can take today as the final verdict or not, because remember that foreign investors are not in the market today. And what happened on HDFC Bank, not to compare earnings or, the banks at all, but just saying that the real reaction came in with the kind of FII selling that the stock had to digest. So, with the lack of participation, even domestic institutions on the sidelines, foreign institutions on the sideline, whether we've seen the final verdict or not, I'd want to hold my breath on it, because while, margins are steady on Kotak, there is a rise in slippages. So is it, less than the market's anticipation, more? How will institutions read the picture? Perhaps, we'll have to wait till Tuesday to get the final answers. But let's kickstart the session talking about the trading strategies that you could consider in this last hour. We have Mitesh joining in as always. Mitesh, good afternoon. Finally, the last hour of the week. So tell us, what are you doing? Anything on the index, otherwise individual stocks?
Good afternoon, Survi. Nothing much on the index. I've maintained that it'll chop around. And that's what is happening. We are seeing bouts of selling and buying. One day Bank Nifty was weak. Today Bank Nifty is strong. Nifty is subdued. So it is a market which is consolidating because the uptrend has come to a halt. And some consolidation will possibly add to strength until we start breaking down. So as of now, the odds are slightly more towards consolidation happening for the next few days, and then the market can possibly pick up steam. On the stocks side, you were just talking about cement numbers. Shree Cement is something which has given a good positive crossovers on the hourly, 2-hourly charts. So that could see good traction in the coming few days. So that's a buy with a stop below 27,350. And I would look at a target of around 28,500, 28,600 to begin with. Maybe slightly higher levels can be tested because the pattern is quite strong on the and showing good traction on the upside. And the second stock which I'm watching is Kotak Bank. It's reversed sometime during the afternoon today, then had a pullback candle, but I think overall the chart is improving. So we'll take a very tight stop at about 17.99 and look for a first target of around 18.55.
Okay, all right. Mitesh, we discussed public sector in the morning, right? And you said IRCTC is one of the stocks which you own in your portfolio. You may want to listen into this next sort of piece. My colleague Hormuz is here, and for the last 2 days, because the pack has been doing so well, he's trained his lenses on what's happening in this in this particular pack. So strong gains once again. The interesting thing, Hormuz, is if the government wishes, right, they can solve this, not solve, but reach and hit and exceed the divestment target. Forget about doing everything together. I mean, they just take, look at railway stocks and decide to do OFS, etc. there. I mean, they'll be home. Take us through the data.
It's the flavor of the season, PSUs, and this rally is showing no signs of slowing down, and it is only ensuring that the government laughs all the way to the bank whenever it decides to monetize this stake, that is. Now, as of today, there are 19 government companies where their stake is more than 75%. As of today, that stake is valued at 2.4 lakh crore rupees. Now, out of these 19 companies, there are 9 of them where the government stake is in excess of 90%. Now, most of the names in this list are smaller PSU banks like UCO Bank, Central Bank, Punjab and Sindh, along with India's largest insurance company, and that is LIC. Now, when we first reported about this in July of last year, that excess government stake that I'm talking about was worth 1.5 lakh crore rupees. Now, by the time we did a follow-up 2 months later in September, that stake was worth 1.9 lakh crores. And now 4 months later, a further 26% surge has taken the value of the stake to 2.4 lakh crore rupees. So which are the companies where the value of the government stake is the highest? Unsurprisingly, it's LIC. Now, having sold only 3.5% stake during its IPO, the government still owns 96.5% stake there. That excess stake, as of today, is worth 1.2 lakh crore rupees. However, in this case, the government still has time until 2032 to comply with these minimum public shareholding norms. Now, next on the list is IRFC. Actually, IRFC is everywhere these days. The government still owns an excess 11% stake in the railway financier, which, if it plans to monetize, will fetch them a handsome 22,500 crores. And as I highlighted earlier, the smaller PSU banks where the government owns more than 90% stake, these ones complete this list. Now, barring most of these PSU banks, these smaller names, most of the other PSUs have seen a stellar run over the last 12 months. Now, take a look at this. IRFC is up 4x. Mazgaon Dock has tripled. HUDCO has tripled. Even a company like General Insurance Corporation, which we don't speak about as frequently as the others, has doubled over the last year. But harping back to IRFC, why should this also be in focus is because its lock-in period is ending on the 29th of July, which will mark 3 years of the stock's listing. Now, that will make 261 crore shares or 20% of its outstanding equity becoming eligible to trade. That's according to a Nuvama note. So, 2023 was the year of the PSUs. 2024 has begun on a similar note. The government is very much in the money. Now, the ball is in their court as to when they choose to rake in the moolah.
Thanks a lot for that, Hormuz. Deepan Mehta joins us on the show. Deepan, what's your take? How would you approach these stocks? Hormuz put that together so beautifully. Your view?
Yeah, good afternoon, Nigel, and thank you for having me on your show. Yeah, I think government is laughing all the way to the bank. And I think it's great news, and it gives a good opportunity for them to disinvest some shares in the next fiscal, which is the election year, and that much more can be channelized towards government spending into infrastructure or even rural upliftment schemes, all of which will benefit the economy in the long run. So here you have a direct correlation between stock price movement, which will increase government expenditure, which will directly benefit higher GDP growth rates, and perhaps even better corporate earnings. So it's great, I think, from a country's perspective. And it's sooner rather than later, I think the government should look at divesting the stakes in these companies. And in any case, I think the need of the hour is to improve the floating stock of these companies, because some amount of froth is also building up because of low floating stock.
Yeah.
Okay. All right, Dipan, stay on. We have more questions for you coming up. I have to look at all the financial numbers that are coming in. So let's bring in Abhishek. We'll start actually with the housing finance company that reported numbers just a while back, Canfin Homes, where there's been a rise in bad loans. The stock had a lot of sort of volatility immediately after those numbers. Abhishek, give us the details.
Well, you are speaking of bad loans, but bad loans has not come in fresh in this quarter. That is what looks like from the preliminary numbers. Now, stress might have come from known stress account. We already had spoken to the management, and their restructured book was due to expire in November. So stress might have come from there, because there is no impact on the yields or provisions that you are seeing in their P&L. Quarter on quarter, the interest income is up more than the calculation on loan growth, and even the provisions have declined on a sequential basis. Talking about asset quality, gross NP ratio is at 0.91% versus 0.76% in the previous quarter. Back of the envelope calculation shows that AUM growth is about 13% YOY and 2% sequentially. Motilal Oswal was working with an AUM growth of 13%. Now, net interest margin might have expanded anywhere between 5 to 10 basis points based on calculation, and cost to income ratio has also improved to 14.7% when compared to 17.1% in the same quarter last year and about 16.25% in the previous quarter. In terms of the P&L, they have given an NII of 329 crore. Motilal Oswal estimate was 327 crore. PAT has come in at 200 crore, while Motilal Oswal estimate was 198.5 crore. Back to you.
Okay, that's Canfin Homes, but let's revisit Kotak Mahindra Bank numbers as well. Abhishek, how are the numbers?
Well, the numbers are a mixed bag. Take a look at the net interest margin. That has worked really well for them. It has held up at 5.22%, while other lenders or other bankers are seeing a decline in their net interest margin. Now, slippages are below analyst estimate at 1,177 crore. We had one analyst estimating slippages at 1,300 crore. Asset quality is up on a sequential basis, but only 3.5%. And the restructured book has declined to 0.13% when compared to 0.15% in the previous quarter. Subsidiaries' profits in terms of quarterly profits are at all-time high. What has not worked is that the loan growth on a YOY basis is perhaps at a 9-quarter low, and loan growth is also below analyst estimate. Loan growth has come in at 15.7% YOY and about 3.25% sequentially. Motilal Oswal was estimating 16.6% YOY growth in loans and about 4% sequentially. Kotak Bank says deposits is a challenge. Take that note very carefully. 24-quarter low in terms of CASA ratio coming in at 47.7%, and deposits growth has been about 15.5% YOY and just 1.9% sequentially. Motilal Oswal was working with a deposit growth of 20.5% YOY and about 3.5% sequentially. What has also not worked is that for the first time in last 10 to 11 quarters, gross NPA ratio has inched up or shown an increase. ROA is at 6-quarter low of 2.22%. So P&L with respect to our poll, NII is a beat. However, profit is below our poll. Back to you.
Okay, so mixed trends over there. Abhishek, hang on, just stay on. We'll discuss ICICI's expectations in a bit. But let's first get Deepan to weigh in on these two earnings. Deepan, so, how should we read Kotak? Let's start with Kotak there, because there is a rise in slippages. And as Abhishek has mentioned, that bank is saying that deposit mobilization is going to be the key challenge. And that's going to be something that the RBI is anyway keeping a hawk eye on. So how would you read the reaction that the market is giving today? And what's your own advice on the stock?
Yeah, I think on the whole, I think Kotak Bank came with good set of numbers, and the key matrix was the pre-provisioning profit, which was, I think, 17-18% higher. And that's so far best in class, even as compared to some of the other smaller banks. And on the whole, of course, there are challenges on the deposit front, but bankers have made a presentation to RBI to ease liquidity over there as well. But the real reason to be overweight to Kotak Bank is the valuation. I think at around 20 times trailing 12 months, I haven't seen the stock traded so cheap since for a very long time, perhaps since its listing as well. And if you're generally bullish on the Indian economy and Indian GDP growth rates, then you cannot be bearish on these large companies like HDFC Bank, Kotak, ICICI, Axis. They are the ones who are going to lend the money to the economy so that the wheels of activity can go on and increase and improve the GDP and the overall activity in the market. So I'm very positive on private sector banks, Kotak Bank included.
And Canfin, any thoughts there?
Canfin is a nice, I would say, conservative lender. They focus on salaried incomes. And by and large, even when the ILFS crisis hit NBFCs, this was one of the safer banks. They had some issue with uncertainty in the top level management, but that has been completely resolved. And I think it's got a great future. Valuations are pretty decent. And real estate sector also is picking up very well, which means volume should do well for housing finance companies. So generally positive on Canfin Homes as well.
All right, Deepan, just coming back to you. Abhishek is still with us. Abhishek, I'll ask you to explain what you're expecting from ICICI Bank, but I just want to put up the IDBI sort of chart. 11% surge. It's a massive move. Have you looked at the numbers, Abhishek? Anything which stood out if you have?
I have not been able to look at the numbers, Prashant.
Okay. So maybe a little later then. Why don't you tell us, ICICI Bank, it should be reporting in the next hour and a half or so. What's the expectation?
Street is anticipating lowest NII growth in last 21 quarters. That is what analysts are pegging in, and profits can decline on a sequential basis. So the key things to watch is loan growth will be strong. Kotak Securities estimate loan growth of 18.5% YOY and about 4% sequentially. Net interest margin can come under pressure. Now this is in line with what we are seeing in the industry. Morgan Stanley expects a 17 basis point decline in net interest margin on a sequential basis. Kotak Securities estimates provisions to increase on a quarter-on-quarter basis. Slippages may rise quarter-on-quarter, but watch out from where is it coming. Is it coming from known stress account, or is it fresh slippages coming out of the loan portfolio? Again, Morgan Stanley expects slippages of 5,250 crore versus 4,690 crore in the previous quarter. Asset quality may remain stable. Our gross NPA ratio as per Motilal Oswal is expected at 2.5% versus 2.5% in the previous quarter. Watch out for the commentary from management with respect to business growth, that is deposit and loan growth going ahead. Two key numbers, watch list at 4,789 crores and restructured book of 3,540 odd crore. How they behave will be seen closely. Our polls suggest NII growth of 12.2% YOY and just 0.9% sequentially. We are working with a profit growth of 20.3% YOY and a decline of 2.5% on a sequential basis. Back to you.
Okay, all right. Thank you very much for that. That is Abhishek there with the expectations on ICICI Bank. Let's just go back to Deepan as well for a comment. Deepan, you mentioned HDFC. So I guess, to wrap up the whole chat on financials, the sense that I get is that, this whole episode hasn't kind of unnerved you. You would still be confident and you would remain a buyer in the large cap banking space?
Absolutely. But the problem with us and most investors is that we are already overweight private sector banks and banking sector. And that really is the issue over here. That fresh money, although however good the numbers will be, cannot be deployed into bank because there's only so much of exposure you can take. But these are stocks to remain invested in. Valuation wise, they are not, expensive, and there's good earning visibility. So far, at least, no signs of the NPA cycle turning. The RBI is very vigilant and proactive. We got these norms on AIFs as well. So they are taking preventive measures as well. With the economy doing well, industrial activity, service activity picking up, capex doing well, and large industries like real estate, capital goods, automobiles still sustaining the growth rates, the demand for credit will be good. So whatever pressure is there on margins will get compensated by higher loan growth. So very positive on the financials. It's just that the allocations and the weightages in the portfolio remain very high.
Already overweight, as Deepan put it. Deepan, thank you very much. Good speaking with you. Enjoy the rest of the weekend. Actually, enjoy Monday as well, and we'll speak to you next week. because Monday, of course, is a market holiday. We'll take a quick commercial break here. You got the market, which I think is slipping a little bit more. I mean, if you can have the Nifty up, I think, yes, we have slipped. So 21,623, 10 minutes back. And
it's Reliance, now down almost 1%.
We slipped 40 points in the Nifty in the last, I think, 10, 15 minutes or so of trade. And maybe, as Surabhi says, Reliance will put it up. Reliance is one of the culprits. It's come off from about 27.20, about 10, 15 minutes back to about to where we are, which is 27.14 or so. Yeah, I mean, there is Reliance has been coming off through the course of the day from the early morning highs that it made, which was closer to about 27.65 or so. We'll take a quick commercial break here. More on markets. Will we see more slippage or will things stabilize? Ajay Vora will also be with us. He's head of equities at Nuvama Asset Management. He joins in on the other side. Stay tuned.
Welcome back. You are with us in Closing Bell. Coal India has seen a big surge in today's trading action, and it reached the 400 rupee mark. Nigel is here to tell us about what's the excitement beyond the fact that the market absolutely loves every PSU stock. Nigel?
Well, indeed, Coal India has doubled in the past 9 months and has hit that 400 rupee mark for the first time in 8 years. You must be wondering what has changed, right? Well, investors have moved on from fretting on the ESG concerns. They've come to terms that India's strong economic growth will result in higher power consumption, which means increasing demand for coal, as well as thermal capacity additions. But what is the recent trigger, though? Why is the stock so excited? Well, Coal India's offtake has increased by around 8.5% so far. With dispatches to the power sector, well, it's exceeded expectations. And to the non-regulated sectors, it's hitting record highs out there. And that's a profitable one, right? Well, this has resulted in coal stocks at coal-based power plants hovering around 32 million tons. That's much better than last year, and it's at very, very comfortable levels as well. Well, besides higher offtake, Coal India has reduced the number of employees by close to around 39% in the last 12 years or so. And this is important because employee cost, that's the largest cost component for the company. Higher offtake coupled with focus on improving efficiencies like reducing the employee cost, well, that's resulted in the earnings per share doubling in 3 years. And Jefferies is talking about these earnings compounding by 5% from year on. So though the stock has doubled, well, it may not look very, very expensive on a valuation parameter. It trades at around 7.5 times forward earnings. It also has that cushion of that 7% dividend yield. Put all this together, well, for the first time in the last 8 years, you have Coal India that's hit that 400 rupee mark, guys.
All right, Nigel, thanks very much. Very nicely explained. And of course you get that fat dividend as well, right? Which is, it's nice. I mean, while you wait for price gains and capital appreciation, it's nice to get paid to wait, which is what Coal India does and so many other high dividend yield stocks as well. I was just looking at the lows. The COVID lows were, on Coal India, it was $109 basically. So it's almost gone up 4 times, although unfair to look at the absolute low, but it's done very, very well. Ajay Vora is with us, Head of Equities at Nuvama Asset Management. Ajay, good to have you with us here. Thanks for your time. Let me just sort of kick it off with your thoughts here on Coal India and some of the others who've all come back in a very strong way. Old economy, old economy sectors largely, very high dividend yields. Do you own any of them? What's the view from here?
Yeah, hi Prashant. Good afternoon, and thanks for having me on your show. In PSUs, as you rightly said, there has been significant transformation in certain pockets, both in terms of, numbers, in terms of outlook, and maybe, that is getting reflected across many stocks. And needless to say that, they were available pretty cheap, I would say a year back or even 6 months back. If you look at the entire PSU basket, and we should not generalize that, but broadly, 6 months back, the entire market cap of all PSU companies put together was somewhere close to $450 billion, which is say closer to 35 lakh crores. And over last 6 months, as we speak, it stands at $750 billion, closer to 65 lakh crores. So, there are certain pockets where I would say that, some irrational or euphoric movement has taken place. Like if you look at, stocks like say ITI, for example, market cap is 35,000 crore and still, negative operating profit. And on the other hand, you'll find certain companies where, EBITDA can be $1 billion and market cap is still $2 billion. So, so in certain pockets, the pricing has played out basis operational, but there are still certain pockets in PSUs where there is euphoria kind of a sentiment.
Okay, all right. Hi, Ajay. Good afternoon and good to see you. Nigel on this side. First of all, I want to tell you, congratulations. I think the last time we joined, you spoke about some OMCs and they have done splendidly well from there. That's the pocket that you liked, I think. And the pharma sector as well. These two, at least I recall that you've spoken about. So what's the view from here on? You've got the call right, but that's a tricky point, right? Now, what do you do? Do you believe there's some more steam left? Would you be a buyer even at these levels?
Yeah, so hi Nigel. So you're right, we were extremely positive on OMC space. And if you go back, a couple of quarters, you'll see that, say suppose a company like HPCL, the market cap was closer to 35,000 crores. And there was a possibility of they delivering close to 20,000 crore of EBITDA. And most importantly, Street was building in a sharp decline in the following year, basis the marketing margins and also the GRMs, which has completely turned around. So if you look at the marketing margins now, they are way higher than what the Street was building in maybe 2-3 quarters back. And going forward also, we don't see those kind of estimates holding true. It will get revised. And on the other hand, if you look at the refining margins as well, Street was building in, pretty conservative numbers over there. So all in all, we thought that, on a steady state, numbers can be pretty high versus what Street was building in. And the EV, if you look at it, stocks were trading at 1 time price to book and 1.5-2 times EV to EBITDA, and that is what has panned out over last, I would say, 3 months. The entire space is up almost, I would say, anywhere between 50 to 70%. And I still believe that from here on, we are getting into a very strong refining cycle going into FY25. And even if we have central election and we had state elections, there has not been a major dip as such on the marketing margin side. So I think if the numbers, what Street is building in, will get upgraded over next couple of quarters, and we'll see stock doing well even from here on.
Okay, got that, Ajay. Hi, good afternoon. I want to talk to you about Hindustan Unilever. Now the stock is down almost 4% because the numbers are obviously they're worse off than even the weakest expectations out there. So the question is really, what is the sense that you get when you talk to clients about FMCG and lever? Do clients see this as a lever-specific issue? And B, could this have a bit of a rub-off effect on the rest of the staples? Or is it a case that, most of the institutions are anyway underweight on staples FMCG, so it shouldn't have a wider market fallout in that sense?
Yeah, hi Survi. So I think at the broader level, what sense we get is, there are two things playing out in a big way. One is over ownership, and secondly is the valuation. So, wherever the valuations are pretty high, and if you look at, Unilever, the valuation is somewhere around 55 times, and you are getting growth which is, less than 10%. And I think investors have been holding these names for a fairly long time. There is nothing wrong with the company, nothing wrong with the business. But the point is that the broader market has got so attractive in terms of the valuations and also the growth rates that people will have to move on to different stocks, different sectors where they can end up making outperformance. So my sense is that and this business is more dependent on the rural segment, which, as we all know, is still lagging since quite a while. Till the time that recovers, I think the volume growth will stay subdued. Once you have volume growth picking up and coming back to those 7-8%, I think you can see some sort of bottoming out in these names. But as I said, the over ownership and valuation is the theme which is playing out in many large cap names, and we saw it across banks and even IT to some extent. So that is, I think, the overarching theme over here.
No, fair point, but one just wonders whether this whole rural weakness argument really holds on its own, because we've seen the recovery in two-wheelers, right? I mean, they're reporting better numbers in domestic sales as well, and that's also a rural play. So somehow it's not adding up. Clearly, there's more to it. Also, just the second part of to that question, is this a lever-specific issue, or do you think this could lead to additional selling in some of the peer companies as well?
So it can be a lever-specific issue because there are certain categories of their business which are highly penetrated now. So expecting very high volume growth in those categories may not hold true, and therefore those businesses can stagnate, or I would say grow at a lower pace. Whereas other FMCG companies where the categories are still not that penetrated can continue to see a little higher, or I would say relatively better volume growth. So my sense is that it can be to some extent a lever kind of an issue.
Ajay, sorry, Nigel was asking about OMCs. Did you have a call on standalone refiners as well, or am my memory faltering? CPCL and MRPL.
I think we spoke about this company, Chennai Petro, which has done exceedingly well.
I mean, it's done.
That's a standalone refinery. And as I said, there are stocks in market where there is a negative operating profit and $4 billion of market cap, whereas this company can end up delivering $1 billion EBITDA, and still the market cap is only $2 billion.
So you still, right? So still bullish on this one, Chennai Petro?
Yeah. So we hold it across all our clients.
Wow. I mean, we are sort of getting through January this year. It's up 20%, 25%, and of course, I mean, 2023 was a phenomenal year. From 200. At the close of 2023, it basically, I think, ended at 700. So it was in 23, it was a three-bagger, more than a three-bagger actually. So that's Chennai Petro for you. Nimesh actually, as part of his editors' roundtable, put out a list of P multiples where they're trading as compared to averages. Just based on that, this looked the most egregious. I mean, I think now it's trading about 8-9 times P from what I remember. On those points. And the historical average, of course, is very low. But Ajay is saying that maybe that's not relevant. Things are looking much better here for oil marketing and maybe even standalone refiners, etc. as well. Anything new, Ajay? Any new sort of addition to the portfolio? Anything you'd like to talk about?
So a couple of themes, we are still pretty positive. I think, the whole housing finance companies are looking pretty cheap. We have seen the kind of action on the real estate side. And, there I think a large part of the positives are getting built in. But if you look at most of the housing finance companies and, start from, say, $500 million market cap to, say, $10 billion market cap, all these names, are still looking pretty attractive considering, the growth path which they have right now. And my sense is that, once the interest rate starts falling, these guys will end up doing pretty well. So overall, housing finance companies is one theme where we are positive. And secondly, this whole tire names, which we have been bullish since quite a while, that, has picked up pretty well of late. But we continue to be positive on this entire tire space because, Prashant, if you look at the business, 65-70% is completely, consumer business. And if the raw material prices stay where they are, even the B2B business, they'll end up making reasonably good margins. And what Street is building in, they are fearing that, the margins will start correcting. But as I said that, if raw material stays here, the margins can actually move higher. And if you look at the valuations, they are still trading at, I would say, anywhere between 12 to 15 times PE or maybe, 4 to 5 times EV to EBITDA. So my sense is that, even this space can continue to do well from here on.
Okay, got that. Well, Ajay, it's been a pleasure speaking with you. Thank you so much for joining in and taking us through this trading Saturday. You enjoy the rest of your weekend and the Monday off as well. Time now to get to our special segment, D Street Chatter. Nimesh joins in and he's managed to pick up chatter even on a Saturday, even when volumes are thin. Nimesh, what do you have for us?
Well, Sirbi, I'm doing a dealing room when there are hardly any dealers in the respective offices as well, right? So, but again, the momentum in PSUs continues, so no point talking too much about that. Again, now it looks like there is a clear divide of camp in the PSUs as well. One who have a bit of a disbelief now after the big rally, and the one camp who still believes that there is a lot of momentum to catch up in the PSUs. So one need to understand which camp they want to be. But apart from that, as rightly pointed out, the volumes are on the thinner side, lack of participation from both FIs as well as the DIs as well. The other couple of sectors which are doing good today are the tire names. So a lot of tire stocks are buzzing in trade, and so is the case with select cement stocks as well. So again, thin day in terms of volumes, but it's the PSUs which keeps outperforming and surprising the street.
Okay, all right, Nimesh, what about individual stocks? You've given us a couple of sectors. Let's drill it down to stocks. Yeah.
Manage few individual names as well. So, Nigel, the first stock on my list today is RBA, Restaurant Brands Asia. That stock is buzzing on good volumes as well. I understand the volumes that HNI Dex has picked up in the last many days, and the street is now anticipating some sort of a global tie-up on the coffee side. So, that's the reason why off late RBA has been buzzing in trade. The second stock is Expro India, a small stock, thinly traded as well. But again, if you look at the shareholding pattern, some large investors own a big chunk. And I understand the company is likely to raise funds via QIP very soon. So that's a trigger in Expro India. The third name is Gujarat Fluoro. Flat in trade today, but off late you've seen a bit of surge in that stock as well. The volumes are on the higher side. And the street is anticipating a foray into the electric battery manufacturing very soon. So that's something to track in Gujarat Fluoro going forward. And the last is LIC. Every day you have at least one stock in my charter list which is part of the PSU basket. LIC is buzzing in trade today on a day when there is not much participation. Though I understand some domestic mutual funds are active buyers in LIC of late, and hence a big surge in that stock as well in the last many days as well as in today's trade.
Nimesh, thanks very much. Interesting list there. So Expro is new on your list, Nimesh.
Yes, Prashant. Small stock, close to 2,500 crore market cap, but if I was just looking at the shareholding pattern, there is hardly any mutual fund participation, but the FI is on a large chunk. Malabar owns close to 11% stake. There are a couple of large individual investors, including Sundar Iyer. He owns close to 1.5–2%, and Ashish Kochole owns close to 3.5%. So good mix of both HNI, smart HNIs and large funds own it, but it's a small stock in terms of market cap, and the volumes are relatively on the lower side.
All right. Thanks very much for that. So interesting list as always, and we'll track it as we go forward. Thank you for joining in, Nimesh. Well, ahead of the Pran Pratishtha at Ram Mandir in Ayodhya, my colleague Mangalam decoded the most popular temple towns in India and the likely size of the tourist economy. Mangalam, over to you.
With the excitement of the opening of the Ram temple in Ayodhya, the cheers that there are and the footfalls that are expected, it's important to look at some of the most popular temples in India as well. And the one that takes the top honors for the longest time has been the one in the southern part of the country, Tirupati Balaji, which attracts 50,000 to 100,000 devotees per day, and a number that swells to 30 to 40 million visitors per year praying to Lord Venkateshwara. At the second place is a number not too far away from the number of devotees visiting the Tirupati temple are in Amritsar, the Harmandir Sahib, the Golden Temple in Amritsar, attracting 75,000 to 90,000 visitors per day. Again, a number that amounts to 27 million to 33 million devotees per year. Now coming down to the metros, in the western part we have Mumbai, the mega metropolis, and out there you have the mega Ganapati temple, the Siddhi Vinayak temple, which attracts its fair share of devotees, and a lot of them coming from the resident population of Mumbai itself. That amounts to 75,000 to 90,000 visitors per day. Again, a number which overall swells to 18 to 22 million visitors per year. Now in a city not too far away from Mumbai, we have Shirdi, and out there too, the temple town of Lord Sai Baba, we have a fair amount of visitors who come in not only from Maharashtra and neighbouring states, but from the country, and foreign tourists too. Close to 40 to 50,000 visitors per day visit the Shirdi Sai Baba temple, and a number that amounts to 15 to 20 million visitors per year. Among the top 4 dhams of Vishnu temple, one of them is in Odisha, the Jagannath Puri temple, and that too gets its fair share of devotees, 20,000 to 30,000 visitors per day. This average number increases a lot more on important occasions like the Puri Rath Yatra, 7 to 10 million visitors per year. Come up north in the hilly region, we have the temple of Mata Vaishnav Devi, slightly difficult to get to, but does not stop the determination of 18 to 27,000 devotees who visit the temple every day. Again, a number that amounts to nearly 7 to 10 million visitors per year itself. To estimate the kind of footfalls that the Ayodhya Ram temple would see, it's also important to triangulate the kind of surge that we've seen in temples post-renovation. And the prime example of this is Varanasi's Kashi Vishwanath temple, which earlier would attract around 7 million tourists annually, but post its renovation, it attracted 73 million tourists in 2022, a number that has surged 10 times and is much higher than all the other temples in the country itself. And this is something similar that we saw in Ujjain as well. One of the 12 Jyotirlingas of Lord Shiva, the Ujjain Mahakal temple, would earlier get about 25 to 30,000 visitors per day. But very recently, we saw the Mahakal corridor being developed, the temple being renovated, and as a result of which, a 4 times jump in the number of tourists is what we saw. Close to 100,000 people visiting this temple. What does this mean for the Ayodhya temple then? Estimates suggest anywhere between 100,000 to 300,000 visitors per day once the temple opens. Sustainably, that could mean about 100 million tourists every year. Each of them spend 1,000 rupees. You have a ready temple tourism economy of close to 10,000 crore rupees.
There you go, the growing temple economy of India, and temple tourism, or spiritual tourism as it's being called, is very serious business. Mangalam there with a fantastic wrap. We'll take a break on that note. Come back, as always, get you some trading calls with Mitesh for the final few minutes of trade.
Well, volume's questionable, but for the time being, the markets are at the low point of the day. So we're down close to around 150 points from the day's high. And that's the way it's panning out. And that's despite the Nifty Bank actually putting its hand up and being counted. Mitesh Thakkar joins us to give us his view on the markets first and also what to buy or sell today for a reverse trade when we come back next week. Mitesh?
Najil, on the index, nothing has changed. As I said, I think, we might see this choppy movement continue. The important thing is that last 2 days have bounced back. We saw some...
I'll only take the lead.
21,700, 21,750 was the level which the markets found difficult to get past. So I think that remains an important level. But that apart, I think, till something big happens, I think you might see the market just chop around. And on the stock side, Torrent Pharma is something, which I would take a BTST call with a stop below 25.20 for targets of around 25.80. Polycab, it had a big fall post that news and then some kind of a pullback. I think that pullback is coming to an end. So we'll take a STBT there with a stop just above levels of 43.80 and a target of 42.75 can be.
Okay, all right. Mitesh, thank you very much for giving us all of those trades. You have a great rest of this evening, the weekend and the Monday break. I'll see you back on Tuesday. Well, let's look at Tejas Networks now. Pull up that stock. It's down about 5.5% in trade today. And that's because something interesting is happening. And there's a lot of divergence between the top line and the bottom line of the company. The top line has grown at a whole 100%. That's because Tejas is now executing very large contracts for a lot of government entities like BSNL as well. But the bottom line has deteriorated and losses are mounting because the company is investing a lot in R&D and in improving its systems to execute these large contracts. So interesting dichotomy playing out. Now, speaking of Tejas Networks, we thought of playing out a small snippet of a conversation that I was having with Vijay Kedia earlier, veteran investor, because he took a big bet on Tejas Network back in COVID. He bought the stock at 40 rupees, and here he explains why he picked it out as a multi-bagger. Take a look. How does Vijay Kedia pick multi-baggers?
No, it's very simple for me, since I have been practicing this since ages, for more than 2-3 decades. So that is why I can say that it's easy, but of course investing is not easy, although it is simple. So as you know that I'm applying that SMILE formula that everybody knows. So SMILE stands for small in size, medium in experience, large in aspiration, and extra large market potential. So this is what I am following. So I am trying to catch a fish in the ocean, not a crocodile in the pond. But my other philosophy is very simple, that I am just tracking, you can say that an athlete, which has set a record in the past. And if that athlete falls sick, I just keep it on my radar. I keep that athlete on my radar.
Okay.
Like a company which has created some milestone in the past.
Okay.
Whenever the last economy was,
the boom cycle was
there. That time they had done some things, they have created some milestone.
Okay.
And now they have fallen sick. So I am waiting for that athlete to recover.
And then start running again.
It's a past glory.
So give us some examples from the portfolio if you can.
I had bought, for example, Tejas Network during the COVID. Okay, so it's a company. It was once before COVID, the stock price was 400 rupees, and it was termed at the only company in India in telecom equipment,
networking
equipment, not in services, in equipment. So it was termed as the maybe Huawei of China,
potential Huawei of India.
But ultimately, stock price did not do well, and company did not do well, and the stock price fell from 400 or 500 rupees to 40 rupees during COVID, and company had a loss of 100 crore rupees in a year or so. So it was an athlete which has created a track record, but fallen sick and came down to 40 rupees during COVID. Of course, COVID also helped it to come down to this level.
Absolutely, it compounded the crash.
So that is all right. But the company was available at a throwaway price. And that time I found that all these telecom services company, because they are giant, like Jio was there, and of course AHL and Vodafone, so 2.5 companies as they call them. So those companies were still surviving, and other all 10 or 15 companies had vanished. So now these companies, the telecom company, had started doing capex and all. And for otherwise they had a very bad patch between 2012 and 2019 or so, or 18 and 19 or so. They did not expand and did not do any capex and all. So I realized that this is the only company in India which into all this network equipment and the future of telecom services company, which are the customers, has started reviving. So to me, it was a no-brainer at that point of time. And the kind of the money the company was losing, actually they had cash in the books. So I bought that Tejas, and luckily it helped me.
I am just checking the stock market price of Tejas Networks right now as we have these conversations. 862.
Yeah.
You bought close to 40.
Yeah.
862.
Yeah.
Now that is the way a multi-bagger.
All right, well, that's Vijay Keria talking about his big bet Tejas Networks. We'll cut across to the Kotak Mahindra Bank press conference on the third quarter earnings. Listen in.
In 2008, 2009. All of this, as if all of this was not enough to create enough volatility, we also have very, very difficult geopolitical circumstances going on as we speak. Within this backdrop, India actually has been relatively protected and resilient, with strong economic growth, improved business optimism, continued rise in public expenditure, and a pickup in private sector capex. Now, all of this is not new news to you, but I think the one thing which really stands out for me is the way India has built out its digital stack. That has transformed the country in more ways than one, and frankly is more than meets the common eye. This continues to be a very significant opportunity and change agent for everyone, including us at Kotak. In this kind of context and backdrop, Kotak occupies a very special place. Kotak is a very strong brand, has a very strong reputation. It is very well capitalized and an incredible platform offering the full array of financial services, products, and services. As I see it, the challenge and the story from here on is how we scale. Scale not just for the size of sake, but scale for relevance. Anyway, that is just 3 weeks into the role. Today, we are all here together to look at the third quarter numbers. And with that, may I request Jaimin to take us through the numbers. I look forward to interacting with all of you on a far more regular basis going forward.
Thank you, Ashok, for your remarks. Jaimin, may I request you to take us through the numbers?
Thanks, Rohit, and thanks, Ashok.
Okay, well, that is Kotak Mahindra Bank. We'll go back to the earnings in a bit from now. But N. Jaikumar is Group CEO and Managing Director at Prime Securities. He's joining us now to sort of take some questions. Jake, it's great to have you with us here. And it's good to see you working on a Saturday. So, good to have you here on the channel. I just want to start with public sector banks, Jakes. Heated debate and old veterans, some of the view that maybe this is getting into dangerous territory now. PSUs, not PSU banks. Others saying, well, there's still value here and profits have also expanded in line with valuations, etc. Where do you stand in this one?
Well, as far as PSUs are concerned, I think difficult to sort of put all of them under one, one fell swoop, as it were, one basket. But if you were to look at what's happening right now, I think the impact of retail is getting seriously unfactored in. What I mean by that is, we all know that retail is coming through SIPs, through mutual funds, maybe some through AIFs, and family offices are coming in. I think the impact of this is that they're getting into spaces and territories with a ferocity that's not being factored in. Otherwise, just a simple statement that the minister makes in Davos that we'll have Swiss technology running our trains or something equivalent to that. And you have stocks on a tear for 3 successive days, not that they've not already moved. So I think the fact is there is a huge desire that retail has to have an exposure in the markets. And I think what that's creating is it's moving from one sector to the other. But the moment a theme catches on, everything sort of moves. I mean, the ridiculousness was almost seen a few days ago when a bank announced the opening of a branch in Ayodhya, and suddenly the entire sort of focus was on that particular bank and on that particular day. I mean, now maybe this is folklore, maybe this is too simplistic, but the reality is retail is having a much bigger say in the markets than any of us have actually felt. We all felt that the money would come in, but come in through mutual funds or come in through more organized spaces. But the way it's coming through in terms of direct exposure, it is frightening. Some of these gains will not sustain. Some of these moves in some of these PSU sectoral themes have just gone to ridiculous levels in the short run. But then who's to say that they don't have holding power? And maybe it is my age coming to the against me in a sense. That's the bane rather than the boom, that we aren't able to see what some of the youngsters are able to see. And some of the younger folks haven't seen a bear market. And good luck to them, but inevitably corrections will happen. They'll be short and swift. But for the moment, because the tailwinds are so strongly India focused, and to the extent that foreigners, FPIs continue to have a trading in and out in India, and look at India in the context of reallocating money to other markets, etc. From that perspective, I think we still have a long way to go because FPIs aren't fully committed to the markets. There is a lot more India allocated money that could come in. And as we enter other indices, etc., this I think will only intensify. So from that perspective, retail has been the smarter trader, if you will, or the smarter investor. And as just like what happened to the Robin Hood phenomena in the US, much the same is happening here. And of course, it's got certain other issues as we hear war stories about individuals losing their money in options trading and getting out of the market. But leaving that aside, because that's a story for another day. But on the investment side, I think there's a lot of new money walking in, which has been not factored in by most folks.
No, absolutely. Jakes, good afternoon, and take your point. And I think a lot of the mutual fund manager bosses, they're sitting up and taking note of this. I was speaking to one such CEO just last evening, a CEO of a very large asset manager, and they admitted off the record that it's great to talk about that 17,000 crore rupees of SIP inflow, but that's gross. If you look at net of the redemptions and the net numbers at the money at the hands of disposable of funds, it's not as large as the headlines perhaps convey. So take that point completely. But coming back to PSUs, aside of the money surge, do you feel there's a bubble when you look at stocks like now, RVNL, IRFC, particularly this railways pocket? Is this becoming a bubble?
Sometimes we tend to take view in, I would say almost intellectual arrogance by saying we wouldn't invest. Now, the fact of the matter is you talk to a young investor and he says, beyond a point, I don't really care what you think. I'm making money, I'm doing what it takes. And to the extent people have invested in these stocks, they've made money. Maybe it's my intellectual baggage that I bring along, if intellectual at all at that, because I'm not invested in these and I haven't made these triple baggers in the market. But, one doesn't know what thesis to invest on. And I think that's where some of us have been sort of grown to understand the way this investing theme is all about, which is that you need a thesis, you need events, you need triggers, etc. Maybe at the end of the day, it's only themes and nothing else that in the short run are calling the shots. So no, I wouldn't be investing in any of these sort of stocks that have doubled and tripled only because I'm not able to understand a thesis or a theme. But having said that, there are spaces and pockets in the PSUs which merit attention. For instance, whether it's PSU banks, which are still trading at close to one-time book, or it's PSU mining and the commodities mining and steel companies, I think there is value there. There are value in individual pockets. There's value in the engineering plays, which are there in the PSU theme, in the PSU basket, because most of these now are taking care of, the big issues around PSUs used to be large labor force, inefficient, etc. There's a retirement that's taking care of X percentage of the workforce every year. Younger people are joining the workforce in some of these. So I suspect with the top management completely geared towards productivity, because that's what's been given as a goal by whether it's the ministry or the government itself, I feel PSUs are coming into efficiency mode. And ultimately, when you make investments, one of the things that you see is, have you eliminated all efficiencies in the system? And from a PSU perspective, because they were so inefficient in the past, anything that they do now is improving in efficiencies. And that efficiency kicking in, productivity kicking in, etc., along with the thematic aspect of the government pushing capex and nominating capex to some of these PSUs, I think the spaces that I talked about, whether it's mining, material, capex related, which I mean capital goods, and those in the capex mode, and some of the PSU banks definitely are well worth looking at. I think all of these have done well, but can do a lot better. I think where the gains have been magnified have been in cases where the government holding is at absurdly high levels like 95, 97%, and the government is only diluted 2 or 3%. So the 2-3% free float acts as the trigger for the balance stock in a sense, or for the pricing to be set. So leaving that imperfection aside, I think the PSU space still has a lot of value, but we need to be clear, we can't be chasing momentum in this. We need to be chasing value.
Okay, very quickly, Jake, so you can squeeze in one. You like PSU banks and select themes out there, some of those PSU themes from across sectors. But what about the private sector banks? How are you placed out there? Very quickly.
Those trading at close to book, and where changes have been happening, whether changes in terms of management, changes in terms of business mix, and changes in terms of board composition, etc., which indicates a new management coming in. My personal feeling is private sector banks close to book will get re-rated much the same way like PSU banks have.
All right, Jake's a little short conversation today, but thank you very much for perspective on two very important themes playing out in the market, and you have a good rest of the weekend. Well, let's start closing out this Saturday trading session. The news is that the Nifty is, heading into the weekend with a cut of about 30 to 40 points. The Bank Nifty has done better. And PSUs, they've, of course, had once again a huge surge. So let's look at the Nifty losers. Why the negativity? Why the red? HUL down 4%. A lot of the large cap IT has seen profit taking today. So TCS, HCL Tech, Wipro, all these stocks are down between 2 and 3%. IndusInd Bank, some selling today continuing, 1.5% down on IndusInd Bank. But if you look at Kotak, which is where the numbers came out in the large cap space, Kotak has done well, 2.5% on the upside on Kotak Mahindra Bank, which brings me to the winners. It is PSUs, even on the Nifty. So look at Coal India making headlines there at the 400 mark, 4% higher. ICICI Bank approaching its numbers very smartly, 1% up. And even HDFC Bank is ending the day with a bit of a positive sort of flip. So Bank Nifty in the green, mid-caps having a good session, up about 0.5%. But the Nifty is kind of struggling with some of these heavyweights under some stress. I think the bell will go off in the next couple of minutes, Nigel, but some more names to add?
No more names. We're done. Done, and we're ready to go home. No, not really. We have a couple of big numbers that's going to be coming out. But the Nifty is going to end with a cut of around 30 points odd. It's totally different from the first tick. In the first hour of trade, we were up close to around 50, 60 points odd. We go home with a cut of roughly around 50 points or thereabouts. Well, we'll wrap up on this session of Closing Bell. Thanks so much for watching. Coming up, we'll have a lot more information on the stock markets. You stay with us.